Hello, everyone. Welcome to the second session of the Who Pays What for Urban Mobility series. I am Eleonore François-Jacobs, Deputy Coordinator of MobiliseYourCity. And today I'm glad to welcome Reda Souirgi to discuss urban mobility infrastructure and transformation funding. This session is part of a series around the publication Who Pays What for Urban Mobility that MobiliseYourCity recently launched. And our session today focuses on how cities and countries can finance large-scale transformation of their urban mobility systems, from infrastructure investment to operational improvements. We will explore the variety of solutions that exist to create viable urban mobility systems. So to discuss this, we have with us Reda Souirgi, who is head of the mobility division at the Agence Française de Développement, AFD. And Reda's work involves supporting countries across Africa, Asia, and Latin America in developing bankable projects, mobilizing public and private finance, and designing financial solutions adapted to local contexts. His expertise lies in bridging project preparation with financing strategies that ensure both feasibility and long-term sustainability. Welcome, Reda. So, sorry, we cannot hear you very well. The sound is a little bit off. We had a check just before that worked fine. It sounds like you're far away. Sorry about this. It leaves an extra minute for latecomers to join in.
Can you hear me now?
Yes, perfect. Thank you very much.
So I have the headphones, but I guess if people can hear me better, it's probably better.
No problem.
Yeah.
Thank you for this quick fix. So I have a series of questions prepared for you, and we only have until 10:30, so let's jump right in. First off, how would you define funding versus financing in urban mobility projects?
Yeah, thank you, Eleanor. That's a key question because there are, I mean, we tend to mix it up a little bit. So, I mean, when we talk to transport financing, we usually refer to raising the upfront capital. Okay, so this can be often done through debt or equity, and it's to pay for basically the initial transport infrastructure costs. And transport financing also refers about how it is done. What is the financial engineering behind? So it will often primarily cover the capex costs through, I mean, different financial instruments. On the other hand, the transport funding refers to the revenue streams that are used to repay the capital and to pay for the operation, the maintenance of the infrastructure, and the assets in the long term. So it answers the question, ultimately, what are the streams that are used to pay for the transport system? So what we see in most of the urban mobility projects that we finance in AFD is that there is often more focus placed on the financing architecture than on the funding architecture, which is a challenge because without adequate planning for the funding streams on a long term for the public transport system, there is a real risk of having the operational model run into a revenue shortfall, which then affects the ability to provide the service, the urban transport service, and also to pay back the financiers that helped to build the project. So we believe that this is why it's important for projects to plan a financial model over a long period of time, which not only include how to raise funds and capital for the capex, for the initial cost, but also includes the operational maintenance and potential expansion costs over the lifetime of the assets and over a long time. And I mean, this is key because in public transport projects, I mean, initial capital costs usually account for 20 to maybe 40% of the total cost of ownership. And the operation and maintenance costs and renewal costs are usually from, let's say, 60 to 80% of the total cost of ownership. So funding this cost over time is key. And if I look at some of the most successful urban mobility projects we have, over time, these are these projects that have strong funding architecture in the long term. For instance, in Morocco, they have set up a specific fund with government contribution, which can pay for the debt, but also for the initial operation cost over a few years. And I would say that these projects, which are built by municipalities, which are used to secure the funding of operation and maintenance over a long time through their budget, are usually very successful.
Thank you. Can you share a quick overview of the key instruments that are used to build financial viability in urban mobility projects? So from loans to grants to blended financing.
Okay. Again, I want to keep this distinction. I mean, the financial viability in urban mobility projects is both linked to the financing architecture to raise capital, but also the funding architecture in the long term. So about the financing structure, it should be optimized to mainly lower the cost of capital and efficiently share risks. So an important instrument that we are, a provider within AFD Group is what we call concessional finance through development financial institutions. So at AFD, our financing mechanisms are primary loans to national or public counterparts, which are, as we say, concessional, which means that the interest rates and the financial conditions are lower than the market. And this is made possible through public budgetary contribution from France, which is official development aid, ODA, and also through our own financial model, which is backed by the French government. And we provide sovereign loans to national governments or with national government guarantee, which is around 60% of our portfolio, but we also do provide non-sovereign loans around 40% of the total to municipalities, state-owned enterprises, public transport operators, which are bankable. So depending on the nature of the projects, our loans, they can range from maybe 30 or 40 million euros to mainly 200 million euros, and even sometimes more for mega projects such as urban rails, metro, etc., etc. AFD also provide grants, but I mean, this is, and in the transport sector, I think this is the case. It's a minority of our total financial package. Huh? Usually, it's around 10%, and these grants, they come from the French government budget, but they also come from the European Union, a lot of them, and some other funds such as the Green Climate Fund, etc., etc. They are generally directed towards preparatory studies such as feasibility study, early design studies, but also capacity reinforcement activities, sometimes project management costs. Sometimes they are targeted to hard assets, construction, works, equipment, mainly because these assets are additional. For instance, considering that an electrified system is better than a diesel system, we will pay for the difference of the cost. No, so when we have this financing package that combines both loans and grants, that's where we talk about blended financing. And of course, the kind of instruments we provide are also, provided by our colleagues from other development financial institutions, and we do work a lot with them. We do co-financing with these actors, such as the World Bank, the European Investment Bank, the African Development Bank, the European Union, but also, of course, we do co-finance projects with private financiers. Okay, private finance is key. I mean, the idea is to also leverage on a private financier for financing the public transport system. So what it is, it's sometimes investors that bring equity to these systems, but also that raise debt. That means that the private actor is the borrower, and they can borrow to specified development institutions that are targeted towards the private sector. For instance, Proparco, which is a private lending arm of AFD Group, but they also can raise debt on, I mean, the market through to commercial banks or whoever, which is usually more expensive.
Mhm.
Yeah.
Thank you.
And sorry, so maybe just to continue. So this is about how we, I mean, set up financing package. But then this financing package, they rely on the long-term funding architecture, okay, during the operation phase. And this should be robust and sustainable. So it comes with, I mean, fair revenues, revenues from public transport users, non-fair revenues, which are tolls, commercial valuation, land revenue capture, advertising, revenues from transport-oriented development, which are very well addressed in the who pays what guidelines that were issued by MobiliseYourCity. And these revenues, they are perceived and owned by different stakeholders, which have an impact on their ability to repay for the capital cost. So the funding architecture is, of course, related to the financial engineering of the project.
Mm-hmm. Thank you. What is your take on PPP as an instrument for financing urban mobility projects, and what are the critical success factors or pitfalls of implementing PPPs?
Okay, maybe I wouldn't even define PPP as an instrument for financing projects. I mean, obviously, there is no such thing as a free meal. It's always been said, but I want to remind it that PPP are nothing but free money, okay? And PPP are a long-term contractual and risk-sharing scheme between the public authority and a private actor, where this private partner is given some responsibilities, some risks, and among them, the risk and responsibility to partially finance the system. But it's, I mean, then ultimately the financial instruments are still the same: equity, debt, blended finance, grants, etc., etc. There is nothing new but a risk-sharing mechanism in a contract. So, of course, to do so, I mean, to partially finance the system, the private partners will need to cover revenues from the transport system itself, whether directly or indirectly. And if it's not revenues from the transport system, it will be subsidies. Many times these subsidies being paid by the public transport authorities. That means less revenues and more costs for the public authorities. So it's a question of sharing risk, responsibilities, and revenues. No. So the main pitfall is assuming that PPPs remove financial pressure from the public sector. On the long term, it's not the case, and we can provide examples. No, but of course PPP are useful because I mean they can improve delivery because I mean the private sector comes as a package with designing, funding, doing the works and construction operating. So it removes interfaces, it can improve delivery, it can mobilize, of course, private expertise. It can also mobilize private creativity of raising new funding sources, making more advertising, more commercial valuation, etc. But they do not eliminate the need of public funding, as I said. So they can be very useful where the, I mean, environment is conducive, when you have a stable legal framework, when you have a public authority which is able to manage a complex contract effectively, and when you have a clear revenue model. The main problem in particularly in urban public transport projects is that the demand risk is huge, and we tend to overestimate the demand to make the PPP bankable on the paper.
Great, thank you. How does AFD appraise a bankable urban mobility project, and how does this process vary from one region to another or from one transport authority to another?
Eleanor, it seems that we have an alarm in the building, which is,
no.
yeah. So I don't know how we can manage that.
This is the first.
I'm very sorry about that, but I mean, this is I don't even know if it's an exercise, so I
safety
think I have
first.
to quit the building.
Yeah, okay. I think then, yeah, we'll let you leave and I
Okay,
will
maybe
just
I try to
conclude.
reconnect in 3 minutes. Okay, I take my computer.
If you manage to do that, that's great.
Okay,
Otherwise,
let me
we
do
will
that. Sorry for the
postpone the
very sorry
session.
for
Yeah.
the interruption.
No, of course, of course. Safety first. Go. Welcome back, Reda, and glad that this was nothing serious. So we will continue our session. I was about to ask you this question on how does he appraise a bankable urban mobility project, and specifically, how does this process vary from one region to another or from one transport authority to another?
Okay, thank you for the question. So, and sorry again for the interruption. I mean, we had a fire alarm in the building, and I had to leave my desk. So, about how AFD appraise a so, I mean, I'm gonna talk about structured public transport systems such as metro, tramways, maybe multimodal transport hub, BRTs, but also eventually urban roads, walking and cycling infrastructure, which is a large part of what we do finance in transport mobility projects. So AFD's appraisal is a systemic process. We are a public development bank. We do not define bankability solely based on the return on investment, such as we'll do maybe a commercial bank. Of course, we do an assessment which is looking at the financial feasibility, the risks of issuing a loan to a specific counterpart, which is a financial part of our assessment process. But there is also a broader assessment which typically looks at economic relevance, social impact, environmental benefits, coherent with the wider mobility system, the way it's going to be operated sustainably or not, whether it will remain affordable, etc., etc. So maybe, I mean, talking about a few important points. After the includes the institutional relevance. I mean, who are the decision maker? What is the buying from this decision maker? What is institution is the public transport authority? Who is responsible for the public transport policy, and how is it consistent? Okay, which comes to the strategic relevance. I mean, is a project basically fitted for purpose? Does it suit the current and future mobility needs in the city, and how it is integrated with a multimodal transport system, including in a network with potentially feeder lines, etc., etc. We can see, for instance, that the risk for, I mean, mass transit infrastructures that are not fitted by lighter systems such as maybe small buses or even conventional buses or small minibuses, tuk-tuks, whatever, and are not integrated in network remains a huge risk, for instance, for bus rapid transit system or for metro system, because as they are not fitted, they don't have the expected demand and the expected revenues. So the strategic relevance and how it is integrated into this planning. And on this, I mean, the MobiliseYourCity partnership is key because it comes out with projects when they have been supported by MobiliseYourCity that are integrated into sustainable urban mobility plans, into a multimodal vision, which is for us a very important way to, I mean, to mitigate this strategic relevance risk. So of course we do appraise the technical relevance and the technical risks. The dimensioning is key. What is the type of the system, the dimension of the system? Does it fit, and does it is it consistent with the expected demand? And I have to say that over dimensioning is a bias that the transport community is keen of. So we really look at, I mean, a proper dimensioning to secure the value for money for the system. Of course, the socio-economic risk and the socio-economic relevance. I mean, how the project impacts job creation, what impact it has on GHG emission reductions, on air quality, on improving access, mainly improving access to jobs, to opportunities, in time savings, etc., etc. This usually is reflected in what we call the socio-economic profitability, which is an exercise where you do monetize all these socio-economic impacts, whether they are positives or negatives. And of course, we do assess the financial viability. I mean, what is the projected ridership? What are the projected revenues? Do they match the cost? What is the equilibrium between operating expenditures and revenues? And what is then the return on equity for the project on a financial point of view? And how does it allow to raise capital or not? Okay, so depending on that, we also assess the relevance of the financial scheme and contractual model, such as, for instance, the relevance of a PPP scheme. So usually, we know that PPP schemes in the urban transport sector, they will not cover a majority of the capex. It depends of the system. Of course, for instance, the AFD, we did finance together with the World Bank urban highway in Dakar, where on its principal phase, the first phase, actually the capex were covered in a large majority by the future revenues of the system in a concession scheme, so maybe up to 80%. But when it comes to mass transit systems such as metro, BRTs, etc., usually, I mean, the revenue flows to the private partner will not allow to cover more than maybe 15 or 20% of the project cost through the private partner financing, maybe up to 30%. But I mean, it's usually not the majority and a limited share of the total contractual capex. And finally, we look at, of course, the social and environmental risks during construction, during operation, the populations to be displaced, and involuntary resettlements are, of course, a very strong point of attention for us, such as for all DFIs, and any other risks that can arise. Of course, this appraisal process, it varies because cities and transport authority are different, because systems are different, because the contexts are different, because I mean, the ability to pay and the affordability of the system is different from one country or another, but the scheme is globally this one.
Thank you. So you talked about the financial viability. Can you tell us a bit more? What are the key elements of a financially viable urban transport project?
Okay. So I think the key element is having a funding architecture that is consistent with the context and the economy and I would say the willingness to pay of citizens in your city. That means that of course you need a clear demand base. You need to have realistic demand forecast, which never happens because demand forecasts are always overestimated. So we stress them, okay, to have, I mean, at some point a lender case, which is a little bit more cautious, very, very often. You need a realistic operating model. You need a tariff policy, which is, I mean, optimal in the sense that it can indeed raise revenues, but it can also secure the affordability of your system so that a greater number of persons will use it. Okay, so it's an equilibrium to balance. But when you have that, you can, I mean, put all this in a financial model, and you will usually see that the funding structure is not, I mean, self-sustaining with only the operating revenues. So at some point, you need additional revenues, which are very often some subsidy framework, maybe from the municipality, from the government, maybe that's subsidies for the initial capital cost, but they usually also need to be subsidies for the operational subsidies. But this can also be additional revenues, revenues from advertising, revenues from land value capture, revenue for commercial valuations in stations, which are kind of effective. And to I mean, to mobilize these revenues, whether subsidies or whether additional revenues, you need an institutional framework which is operational, because I mean, you have at some point flows that are crossing from one sources to your transport system, and this requires an institutional setup which is strong and which is stable. So I think these are for me the key elements of a viable urban transport project.
Mm-hmm. So for you, what are the main risks in financing urban mobility infrastructure, and how can they be mitigated?
Okay, so if I have to maybe sum up the main risk, I would say first the demand risk, the operating risk, and at some point the construction risk and political risks, but this will depend also on the context. The demand risk is always there when it comes to urban transport. The key thing in urban transport is that the demand is not captive. You always can choose another transport mode, and you always can choose even not to move, not to make the journey if it's too expensive or whatever. You will sacrifice maybe one visit to a friend or even potentially your job, but if it's not, I mean, affordable for you, you can do that. So the demand risk is very high, and it's usually not mitigable by anyone but the public transport authority, or let's say the public authorities. Why? Because this demand risk is linked to the organization of the urban mobility system as a whole. Okay, if you don't have feeders, if you don't have intermodality, if you do not organize your network, if you have I mean, paratransit operators that operate in competition to your bus rapid transit, etc., you will have a demand risk. And what we can see in many systems is that because of these conditions not being made, the demand risk materializes, and you have very, very strong revenue shortfalls. We can see it in African BRTs now, okay? But we also saw it in urban rail system, metros, etc., etc. It's not always, but so this demand risk has to be at some point in our mind beared by whoever is organizing the mobility system as a whole, which is usually the public authority. It can be a little bit, I would say, shared with others, maybe the operator with a revenue, I mean, with a bonus malus scheme on its performances or whatever, but it cannot be purely built by others, except in a very few cases which are scarce. Okay, the operating risk can be usually better taken into account because you have very professionalized operators around the world. We have in France's many, I mean, worldwide recognized operators. You have others, and I mean, but of course there is a risk on cost. There is a risk on inputs such as fuel, whatever, or electricity, etc., which remains always there, but usually can be contractually managed and technically managed, except that sometimes it have a cost. And the best way to manage it is also to raise the fare progressively, because I mean, or to raise whatever fee is paid to the operator progressively through a proper formula which allow to I mean to increase this payment over time. Construction risks are very dependent on the project, but of course they can be huge for underground metros or complex projects. And political risks are not to be underestimated, because these are projects that are long to be implemented, and you can have electoral cycles, economic or political instability, even, I mean, political influence into the institutional setup, which can be indeed a real risk on projects, and have to be, I would say, carefully estimated, addressed, and considered for a lender.
Yeah. Thank you. We have 2 questions left and only a few minutes, so we will try to stay brief for these last 2 questions. The first is, how can cities better prepare projects to attract international financing?
So I think first, I would say a strong strategic case, meaning you come out with a sound planning, multimodal planning, thinking about how people will use the system, and not about only I want to make infrastructure, etc. Um, and of course, which I will maximize the fitness for purpose and the value for money and the dimensioning of whatever is your project. Then you need a strong governance structure, I think, because I mentioned it at some point. If you want to bear the demand risk, if you want to mobilize additional funding sources, you need a strong governance structure who is indeed in charge of implementing the project, operating the project over time, and what is the political backing of this. Very important. And then I would say a credible financial model and economic model with no, I mean, overestimated demand, underestimated cost, etc., etc., and model showing how will you fill the gap, and particularly the gap in the funding architecture. And if it requires subsidy, it's good for a lender to know that there is a willingness to pay subsidies, operational subsidies from the government or from the municipality, or that there are other plans to raise additional funding sources.
Mm-hmm. Thank you. The last question is, how can concessional finance be used most effectively to unlock larger investments?
Okay, so first, I mean, concessional finance is a broker of confidence, no? So, I mean, you have the first thing is that, maybe starting by the beginning. The first thing is that with concessional finance, particularly with grants, you can help diagnose pain points in the early stage, prepare projects, prepare planning, etc., etc. So that means that you can come out with projects that are potentially bankable in the sense I mentioned earlier, no? So use grant for that mainly. Then when it comes to, I mean, financing the million of USDs that are usually required for capex, you have to use it as a broker of confidence and use it catalytic effects, meaning that you need to optimize financing structures that comes out with probably concessional finance provided by DFIs. I mean, semi-concessional finance providing by other actors such as export credit agencies or maybe DFIs targeting the private sector, etc., and eventually private capital. Okay.
Mm-hmm.
And the other way you can use concessional finance is de-risking. Because I mean, usually DFIs, they do not only provide loans, they also provide guarantees. So you have, for instance, guarantees for public payment risks, because when you have a PPP scheme or even when you have a subsidized system, there is always in countries which are not so bankable and where there is a macro fiscal risk, you always have a public payment risk, so which can be guaranteed over time by actors like AFD or others. There might be a political risk, and also there might be some technological risk, particularly when it comes to transitioning to, for instance, e-mobility or electric buses, etc. So you can have de-risking instruments that are concessional provided by DFIs, which will cover some of these risks and allow them to mobilize, I would say the markets, capital markets, and even commercial banks, or even specified actors targeting particularly the transport sector or the vehicle sector, etc. So there's another way to use the concessional finance. And of course, you can use it to innovate. For instance, I mean, you can use grant to do pilot projects on innovative schemes, innovative assets, innovative technologies. That's, for instance, what we do in AFD. We do finance pilot projects for road safety, for electric paratransit, for non-motorized transport in very specific contexts, etc., etc., and how it articulates with, for instance, mass transit. So that's another way to use concessional finance.
Thank you very much. Do you have maybe one key message that you want to make sure our participants go home with?
Yeah, maybe my key message is that, and particularly for practitioners in urban transport, is that funding urban transport is not something neutral. It's a political choice. It costs to the society, to the municipality, but it also comes with socio-economic benefits. So you have to make political choices about how you want to fund, who will pay, but in front of these political choices, you have to be sure that you have strong benefits, strong social and economic benefits. And when you really do that, really think about it, usually it's very good to come and see DFI such as AFD with a strong case.
Thank you very much, Reda, and thank you for these great insights. It was a very interesting session, and I've read already some positive comments also in the chat. So we're now coming to the end of this Expert Voices session. And before we close, I'd like to remind everyone that the third and final session in this series will take place tomorrow at 10 a.m. With Yen Jennings from EBRD. It will be on developing urban mobility portfolios in African cities. So apologies again for the little mishap earlier, but glad that nothing serious happened. And thank you all again. Have a great day, and I hope we see you again tomorrow. Bye.
Thank you, everybody. Goodbye.